This is Sacha Pradyuman of Cirrus Research. The briefing report is just out. The title, Rest of Market Offers Ballast to the AI Complex Break. As we know, July was a very volatile month. We had a record amount of AI hardware-related semi-equipment, memory-related stocks come down hard. Some of this was also global. The nature of the stocks from South Korea, we had a massive pullback there. To some degree, this was a ripple effect that may have started there and started to echo straight through our AI vertical here. A few of the quick takeaways, though, in terms of what we're seeing, was that as much as the market and the specific AI verticals pulled back hard, the net numbers were fairly stable. In other words, the market was slightly down, small caps lost like 3% or so. Bottom line, though, a lot of stabilization seemed to be there. So the question is, what's going on? So what we've been, really arguing for in the past year or so is this idea that valuations are starting to matter. Our indicators are now starting to turn that way. In addition to that, what made July an even more relevant case is that the speculative readings we had like flashed red at the end of June because we had this enormous meltdown. And to some degree, that worked pretty much right on the money. And as we saw the pullback, by definition, whether there's a value rotation or not, undervalued stocks lost less ground. But when you decompose the numbers, what we also see is that a lot of sectors were still in the green. So in other words, we know given the Hormuz Strait issue, the energy sector bounced. But you also had major groups such as financials also really post fairly good gains. Part of this relates to the earnings cycle. Earnings reporting season that we're going through, that those numbers, the earnings reporting season has been very good. And we're still seeing a very dominant AI revenue story. That said, the sort of speculative fervor that we saw, the run up going into the earnings season, to some degree, this was just a chance to release some of the pressure that had built up, not just in the US, but globally. This chart here relates to the fact that deep value blends have started to, on a relative basis, begin to perform very strongly and now starting to take its toll against pure trending strategies or the aggressive growth models. I think this is important in a world that if fundamentals were to act better, by definition, you're going to see these more value-centric models perform better. On the growth front, we could consider this to be the GARP models will also outperform. One important nuance with the AI trade is this term of AI disruption. So where is it going to be? We understand that within our downstream AI bins, it was a very hard, tough month for hardware. So the semi-related AI names were down about 16%. Data center-related plays were down 7.5%. A lot of industrials really struggled in this pullback. But take a look at what's going on the application side, whether it's office application, consulting, and even cyber. A lot of these stocks are now starting to come back to life. So it does look to us that the market is beginning to be more nuanced about how they see the AI disruption. This is something to watch given the break that the software groups have had broad-based exposure to selling in the last year. Importantly, our forecast for growth value. Why are we seeing more of a sharp break in terms of large cap value outperforming large cap growth, less so with the smaller cap side? And what we're seeing is that the valuation extremes is effectively really lodged in the large mega cap growth stocks, the sort of like hyperscalers of the world. So I suspect that's why the rebound of value, even though it's coming across the entire market chain, food chain, the more distinct and dramatic outperformance is being seen in the large cap camp. I think this is likely to continue because of this fundamental gap that currently exists that we're not seeing in small caps. And one interesting, important fallout is that the silver lining in this noisy, value-ish leaning period is that the active blends that we run, a majority of them are working better and better. So in a month such as July with the sell-off, we saw all three of the value-based models outperform. Granted, a strong financial sector will do that to value blends. But importantly, though, both the quality growth model and the GARP models were benign to positive. The only model that really gave ground in this sell-off month And to no surprise was the aggressive growth blend, which is a ton of trending characteristics. Take a look at the full report. And as always, happy to take your questions. Thank you.